Whenever a batsman decides to hit a six, he takes a risk. He has to create space for himself, he has to leave the crease, he has to swing his bat hard, and he has to hope not just that he doesn't miss the shot, but also that it is perfectly timed so that it doesn't end up in the hands of a fielder. And sometimes the risks make sense. Say it's the last over, there's a target to be met, it's do or die. But sometimes in cricket, all you need to do is hold your nerves, preserve your wicket, and keep batting consistently. At such a point, hitting a six is just too much risk, which is what the RBI tried to pull off in the recent June Monetary Policy Committee or MPC meeting. So a quick background, the MPC is a 6-member panel consisting of 3 members from the RBI, including the governor, and 3 external experts. These 6 people meet once every 2 months to vote on whether to cut, hike, or leave the policy interest rate or the repo rate unchanged. This policy rate ends up affecting all other interest rates across the economy, be it what you're paying on your home loan or what you're getting on your fixed deposits. So why does the RBI keep playing around with the interest rate? Well, to control inflation. More specifically, to ensure that inflation is durably close to the target of 4%. But how does that work? Well, let's say inflation is too high. So the RBI raises the policy repo rate. That in turn raises interest rates across the spectrum. Higher interest rates reduce people's appetite for loans. As credit growth moderates, in theory, so should economic activity, which means that people now will be demanding lesser goods and services. So the companies providing them will now be forced to keep their prices under control, which in turn reduces inflation, because after all, inflation is just the rate of change in prices. I mean, there are other ways of monetary policy transmission too, but by and large, this is the most popular route. But the RBI's job is also to keep an eye on growth. It can't raise interest rates so high to bring down inflation that it completely derails the country's growth. So the RBI has its hand on the ceiling fan regulator. It can't allow the economy to get too hot, but it also can't allow it to get too cold. And so the RBI's policy repo rate goes through cycles. If you look at the historical chart of repo rate, it's not like they hike one meeting and cut in the other. When inflation is high, the RBI hikes, then it pauses when it thinks interest rates are high enough to get inflation under control. And then when growth starts to slow, the RBI cuts till it figures out that, hey, interest rates are now low enough for growth to recover. So which part of this cycle are we currently in? Well, before the pandemic, the RBI was cutting interest rates as growth was already slowing. During the pandemic, growth tanked even further, and the RBI again aggressively cut interest rates with the repo rate down from 6.5% to 4%. It kept it steady at 4%, but then inflation started rising. Also, the Russia-Ukraine war broke out, raising global commodity prices, and the US Central Bank, the Federal Reserve, started raising interest rates. So RBI realized that inflation was now too high to be ignored, so it urgently started raising interest rates. And the RBI hiked it up all the way back to 6.5% and then kept policy repo rate there. Circa 2025, we are now back to cutting interest rates. Inflation has rapidly fallen. In fact, the latest number is a near 6-year low, and at less than 3% is undershooting the RBI's target of 4%, and cracks have emerged in India's growth story. The RBI first cut the policy repo rate in February 2025 by 25 basis points, or 0.25%. So 100 basis points is equal to 1%. Now, conventionally, rates are hiked or cut in installments of 25 basis points. Whenever the quantum is higher, more often than not, it's because there's an economic emergency that has happened, something that the RBI wasn't expecting, and now it has to quickly realign the interest rate cycle to react to the new normal. So, February meeting, 25 basis points cut, no problem. 2 months later, the next meeting in April, another 25 basis point cut. Again, no problem. Then came the June meeting. Inflation was still low, growth situation still hadn't materially changed. Markets were like, RBI, nice and easy, just run between the wickets and deliver another 25 basis points cut. But turns out the RBI had different plans. Without warning, it hopped out of the crease and swung its bat to announce a jumbo 50 basis point cut, along with 2 other major decisions, which we will be discussing later in this video, that were equally bizarre. And everyone was like, what, why, what's going on with the economy, that the RBI felt the need to cut interest rates so aggressively? Hello and welcome to the Bond Economist, your one-stop destination for professional advice on the economy. My name is Auradeep Nandi, and today we discuss how and why the RBI went rogue. What were the fireworks that took place in the June policy meeting? Why they don't seem to make sense? And what does it mean for the economy? As always, if you like what you see, please do share and subscribe. And if you'd like to support me, feel free to scan the QR code on your screen or use the super thanks button below. First things first, how exactly does the RBI control interest rates? Well, broadly speaking, there are three ways. One, as we just discussed, the direct way, by hiking or cutting the policy repo rate. Second, the RBI can influence market interest rates by talking about where the policy repo rate is headed in the future. For instance, if the RBI says that we can cut in the coming months, then that influences the expectations of banks and other money market players, and they now start trading securities at lower interest rates. This forward guidance comes from comments that the RBI governor makes in the media, which is why every interview, every remark of the governor is watched very closely by markets for clues on where interest rates might be headed next. But there is also a formal mechanism. In every MPC meeting, the RBI not only decides on the interest rate, but also adds a policy stance to accompany it. And there are three such stances. Neutral stance, which means that the RBI has the flexibility to either cut, hike, or hold the policy rate where it is in the coming months. Accommodative stance, here the RBI wants to signal that interest rates from here can be cut or kept where they are, but rate hikes are firmly off the table. Accommodative stance is meant to tell markets that, look, interest rates are headed lower or will remain low for the foreseeable future. And the third option is tightening stance, where the RBI says, I can hike the policy rate in coming months or keep it where it is, but rate cuts are not going to happen. So the idea here is to guide markets towards higher interest rates or lower interest rates, whatever the RBI wants. The stance is meant to give a sense of that direction. So you can change the policy rate, you can talk about where the policy rate is headed. And the third tool in RBI's box is liquidity. RBI is the god of liquidity. It controls how much money is sloshing around in the system. Liquidity is like water in a fish tank. So imagine banks and other financial institutions are like fish in the tank. Too less water and they are gasping for funds for their daily needs, and interest rates spike up. Too much water, interest rates fall, and the fish become prone to jumping out of the tank, making risky investments. And normally the economy keeps adding and removing water from that fish tank every day. For instance, when we withdraw cash from the ATM, that's draining liquidity. On the other hand, when government spends, the money gets deposited in bank accounts of lakhs of people providing goods and services to the government. So then the tank fills up. But sometimes the RBI has to step in when it feels that the general water level in the tank is just not right. If it's overflowing, it will drain some away. If it's falling to critical levels and banks are struggling to borrow, then the RBI can also pour water in from its side and then, prevent the interest rates from spiking up too much. And there are many ways it can do this. It can buy bonds, which in turn means it is releasing cash from its coffers into the system. It can buy dollars from the market and in the process inject rupees in the system. It can also reduce the amount of minimum reserves that is mandated by banks to be kept with the RBI, also known as the cash reserve ratio. So what's the RBI been doing with these levers? Well, it's been trying to execute a U-turn. The previous governor, Shaktikanta Das, kept things tight. Even as growth was slowing and inflation was falling, he kept interest rates elevated. He kept communicating that the RBI will keep interest rates higher for longer, overconfident on growth. He had also tightened the screws on finance companies that were overlending to households, which contributed to retail credit growth slumping. And in an effort to stop the rupee from depreciating, he sold dollars, in the process soaking up rupees and presiding over a sharp decline in liquidity. By the way, each of these topics have been covered in detail on this channel. I have left links in the description. Please feel free to browse through them. But then the government didn't renew Shaktikanta Das's term, and in came Finance Ministry insider Sanjay Malhotra. And he understood that growth wasn't in good shape. And he also realized that inflation is now at or in fact tracking below the RBI's target of 4%. So there's nothing to gain by keeping interest rates high. In fact, it will be damaging growth even further. So he did a massive U-turn. To bring down interest rates, he poured in liquidity into the system. The amount of money that the RBI has been injecting into the system in the past 6 months is starting to rival what was done during the pandemic time. And you can see how durable liquidity in the system that crashed during the last few months of Das's term has spiked back dramatically under Governor Malhotra. He also reversed the curbs that the RBI had put on finance companies. And as we had discussed earlier, he started cutting interest rates. In fact, after cutting by 25 basis points in February 1st, in the April meeting, along with the second 25 basis point cut, the RBI also changed the policy stance from neutral to accommodative to signal that low rates are here to stay. So how did the RBI mess things up in the June policy meeting? Well, the RBI announced three things, all of which were shocks to the market. First, the RBI cut the policy interest rate by an unusual emergency level of 50 basis points or 0.5% to bring the repo rate down to 5.5%. Second, it reduced the cash reserve ratio. Remember, this is the proportion of deposits that banks have to compulsorily keep with the RBI. And that proportion has been reduced from 4% to a low of 3% to be done in installments from September onwards. Again, this was something that was done during the pandemic time. So if banks no longer have to keep this money as reserves with the RBI, it can then technically use this money to lend to one another, which in theory should add to liquidity. And then bizarrely, the RBI said, okay, we have given you a 50 basis points cut. We have announced getting the CRR or the cash reserve ratio down to record low levels. I think we are done for now. And so they flipped back the stance from accommodative in the April meeting back to neutral in the June meeting. So remember, the stance was neutral in Feb, it was changed to accommodative in April, and now it's once again back to neutral in June. Big mistake. The policy stance isn't meant to be changed once every 2 months. A change in stance is like a ship blowing its horn before changing its course slowly. It is not like flicking the car indicator on and off whenever you want to make a quick lane change. And this is not just fancy economic theory. As we will discuss shortly, the flip-flop in stance is having real-world consequences in financial markets. But to understand that, we need to first address the elephant in the room, the jumbo 50 basis points cut. Why did the RBI do this? After all, what was the economic emergency? A week before the policy meeting, the government statistical agency announced that India's GDP growth rose to 7.4% in the Jan to March quarter, up from 6.4% in the previous quarter. I mean, look, there are a lot of problems with this 7.4% number, and we'll probably discuss this in detail in one of the subsequent videos. But nevertheless, even a 6.5 to 7% growth rate isn't bad. Even if one looks at how monthly indicators have done lately, let's say GST collections, auto sales, diesel sales, etc. in April and May, it's a mixed bag. Some are picking up, some are showing weakness. But nothing suggests that the economy has fallen off a cliff, which begs the question, is the RBI seeing something wrong with growth that we are unaware of? Now, Governor Malhotra explained this huge cut by citing two reasons. One, he said that don't worry, growth is fine, but our aspirational growth is 8%. So even if we continue to expect a decent 6.5% in FY26, to reach 8%, we need to cut interest rates. Now, this makes little economic sense. Typically, interest rates are set based on two factors. A, how much inflation is above or below the central bank's target of 4%, and B, how much growth is above or below the economy's potential growth level. Now, they may sound similar, but potential growth is very different to this aspirational growth that Governor has come up. Potential growth is the long-term, sustainable run rate of the economy given our resources and technology. So this is the level of growth that doesn't cause high inflation. And while there are different ways to estimate potential growth, the general consensus among economists is that India's potential growth is probably around 6.5 to 7%. So if the RBI's forecast for this fiscal year is 6.5%, we are actually close to or slightly below our potential growth. But there's nothing to suggest that, a 50 basis point cut is needed ASAP to correct this gap. By saying that forget potential growth, we will justify this rate cut by focusing on some random aspirational growth that seems to be borrowed from a kind of promotional Sarkari brochure is unheard of in central banking. The other reason the RBI cited for cutting rates so aggressively is that it is front-loading rate cuts to help with policy transmission. What does this mean? So the RBI cuts policy repo rate. That in turn affects the call rate, the rate at which banks lend to each other for their daily needs, which in turn affects longer-term interest rates in the market and eventually trickles down to loan and deposit rates. As loan rates reduce, the hope is that credit growth picks up, and once credit growth picks up, the hope is that GDP growth picks up. But this transmission from the policy repo rate to each of the interest rates in the system And then from the financial system to the real economy takes time. So the RBI says that, look, by delivering a big cut at one go, we are giving a big push to the transmission process. It will force banks to cut loan rates even faster. So instead of 225 basis points cuts being spread over 2 meetings, we are now delivering it at one go and hoping that it will create a bigger impact. The problem, though, is that the RBI simultaneously announced that the stance is no longer going to be accommodative, that we are changing it to neutral. Now, the puzzling thing is that the RBI could have comfortably continued to keep interest rates at hold under accommodative stance. Because after all, what is the definition of accommodative stance? That the RBI can either cut or keep interest rates on hold. All it does is to say that rate hikes are off the table. So if you want interest rates to head lower without cutting the policy interest rate too much, then stick to accommodative stance, because that will signal to markets that there's always the possibility that the RBI can cut later. Who knows? But by declaring neutral stance, by definition, the RBI is saying, I can cut, I can hold, and I can also hike interest rates. And financial markets are like, wait a minute, are we wrong in thinking that the RBI wants interest rates to head lower no matter what? And Governor Malhotra even said as much. He said that monetary policy is left with very limited space to support growth. So the markets seem convinced that the rate cut cycle is now over. Interest rates need to be higher than what we were anticipating. And so paradoxically, despite the RBI delivering a 50 basis points cut, the yield on India's 10-year government bond raced up in reaction, which is something you want to avoid when the goal is to convince banks and financial institutions to lower their interest rates. But there is also a bigger risk at play here. In every casino movie or a casino scene in a movie, there's always that one guy who gets frustrated with where the game is heading and then pushes all his chips to the center of the table and says, I'm all in. And more often than not, it is that guy that loses big. By giving 50 basis point cut at one go, by announcing cash reserve ratio cuts in the future, by publicly admitting that we, the RBI, don't have space to cut any further, Governor Malhotra has basically said, I am all in, which begs the question, what if growth doesn't oblige? After all, lower interest rates on loans doesn't always guarantee that there'll be demand for them, because interest rates are not the only factor that influences borrowers. Currently, consumption is hit, particularly in urban India, because even with lower inflation, households have to contend with weak income growth. There's also the suspicion that households may have taken on multiple loans that they are now struggling to pay back. Corporates are also seeing the weak domestic demand, the uncertain global environment, and could very well end up saying that, hey, we will continue to wait and watch from the sidelines and not commit to major investments right now. I mean, it's not like rate cuts are useless. Interest-sensitive sectors like real estate, consumer durable goods could very well react well to the lower interest rates. But it may or may not be enough to rescue overall growth in the economy. So you need to keep some monetary policy powder dry in your arsenal in case you have a real emergency later. For instance, in Operation Sindoor, I'm sure India didn't send all its missiles and all its fighter jets to Pakistan, because you need to have some power left to tackle the problem if it's still not solved. To get back to the analogy we started with, the RBI has essentially attempted to hit a 6 at a time when it should have ideally been consistently running between wickets, which means that we are all now forced to look up at the sky and wonder if the ball will cross the boundary line or whether it will get caught. For more such insights, like, share, and subscribe to the Bond Economist.